well just go ahead and tell you the story. I've been trying to tell this story for like 4 days now. And this is what the story has to do with. Basically, look at the 1 year chart for the Dow Jones. And if you do this, I wanted to show you guys something. Look right here. Pay attention now because it's very clear if you're actually looking at it. So basically, I snap a picture of that. And this was last year. This was the pattern that it took. Let's zoom in right here. We'll get it drawn out and then you take a look. It's a drop from a high down to the 200 day, then a return. Let's do this a little bit better. Let's zoom in even better. Let's zoom in better and make this thing smaller. Now watch. A drop down to the 200 day, back up to the green and maroon EMAs. So 9 and 13 day, then back down through the 200 day moving average, then up. And then one green candle of above this line here, which is the 200, forgive me, the 50-day SMA. And then last year it was a drop back down, deep drop, by the way, all the way back down. Now watch this. Zoom all the way out. We have a drop from a high down to the 200, bounce up to the 9 and 13 day EMA, which is those green and maroon one there. Then returns back down to the 200 day through it, and then back up to the 50 day SMA, then a green candle, and then a red candle. Let's look at that chart. The only thing missing that this one has that the other one does not so far is the big ass drop. Connect it and watch. See? It's the only thing it's missing. And that's what has me concerned. Now, of course, that has Scott Minerd concerned as well. If we take a look at Apple News, what Scott Minerd had to say, we'll go into the Save Stories. I remember I read it. I was telling some people about it. I shared it. Right here it said, one of Wall Street's premier investors says S&P 500 may tumble 16% by summer's end because markets never had a trade war like this. And we know that now. I mean, he was going after Mexico. He was obviously really giving it to China at this point, threatening like another $300 billion of products that are going to get tariffs 25% slapped on them. And it says, enjoy Thursday's muted. This is back on June 3rd. It said, enjoy Thursday's muted stock market bounce because Scott Minerd of Guggenheim Partners says it won't last for very long. The chief investment officer and one of the world's premier bond fund managers, in a late Wednesday interview, told Market Watch that the equity market is likely to stage a mini rebound in the coming session. This was, remember, June 3rd. It literally rebounded from June 3rd to June 10th. So it's going to stage a mini rebound in the coming sessions, but then watch out. The investor said that by the end of the summer, like we said before, U.S. benchmarks could fall to lower lows than those produced during a withering fourth quarter sell-off that culminated in the ugliest Christmas Eve trading session in history. The trade tensions are likely to get a lot worse because we have never in modern times had a trade war like this, Minerd said. A fall to at least its December low for the S&P 500 would represent a decline of roughly 16% from its current level. The Dow Jones Industrial Average, a drop to last year's nadir, would mark a more than 13% skid. For NASDAQ, more than 18%. So if you look at that, you're in a situation where one of the premier bond fund managers, by the way, Bill Gross went on to say that this guy is it, not anybody else, not Tepper, not anybody. He said Scott Minerd is the man when it comes to bonds. He's going to be the bond king. And that's a way harder market to rule the way he does. So just understand when he says, he's talking about massive policy. Bonds, it's macro environment, micro. It's so much more. Where stocks, you can find a good company, you can put some money in, and you can make money if your research was correct. These guys are manipulating vast markets, having to understand huge economic outlooks that me and you just cannot comprehend because we don't have the research team and data and we don't have the experience. But he does, and if you look at that right there, now even consider what we were looking at the other day where you had the TVIX was up when the market was up 390 points. The market was up 390 points and the TVIX was up 1.2%. There's no way that should be possible. The only way that could be possible is if there's a vast amount of fear when there should be a vast amount of, I mean, it could happen because even when stuff is increasing that the way it is, obviously that giant push is going to create some fear because people are going to say, well, there's no push like that without pullback. But remember, say a healthy market will take the stairs when it goes up, but on the way down, it still takes the elevator. So what do you think a wild, crazy market does that has, I mean, guys, look at this. Guys and girls, look at this. There's nothing good about that. I know we'd like to say that's good, but it's not good. It's not healthy. This is not a healthy thing. I mean, these are 1,000-point swings in a week. This is from 26,664 down to 25,250. That's a 1,200-point swing in a little over a week. Actually, from this day to this day, it's 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12 trading days. I mean, that's that's just 2 weeks worth of trading days of freaking disaster. And then you get this, and then boom. I mean, think about it. And then you get over 1,000 point here. That's not a healthy market. And I want to show you guys the TVIX real quick. And the reason why is because you can actually see it setting up. It's about to pop. Yes, the TVIX, 2 times velocity share VIX short term, it absolutely reacts to the market the same way any stocks do. Like it acts just like a stock. Let's just take a quick look here. Snap this. We're going to do the actual trend lines. Had a friend of mine. He's like, bro, did you know the SMA and EMA aren't trend lines? I'm like, bro, don't tell me they're not trend lines. I call them trend lines. They'll never change. They are trend lines. They tell you the literal trend of stocks. People like to refer to these as trend lines. And I knew exactly what he was talking about. I was like, oh, you think that's what I call a price channel? And I said, I understand trend lines build a price channel, but I don't even refer to them as trend lines. Because in many cases, look, you call that a trend line. Like, okay, let's say this was the trend line. Let's say this was the trend line. And this is the way you wanted to look at it from a perspective like this. I mean, look at the vast gap in between that cannot be accounted for. I mean, look at that. It's ridiculous. And so I say, no. Use the EMA and the SMA as your trend lines. And that will give you everything in between. So I understand these are your long-term major trend lines. These lines here. But realistically, if you want to consider what that actually means, what you're actually saying is all of this stuff in between. This right here, what doesn't really, I mean, these are like 10 to 32. Forgive me, that's over $10, $12 swings, 13. So you just want to not account for the $13 in between. And the only way to account for the $13 in between, meaning the $13 swinging, is to get in there and know these trend lines, the ones passing through it, to know it on a 5-day basis. But anyways, let's look at this. So look, it turned upward now. If you look at the 1 month, it totally flattened out here and it's about to make its move up. It was green today. That day it was green when the market was up 390 or like almost 400 at its high. And so look what it's trying to do. You got, just taking a look here, you have the low and then a low. Well, those are lower lows. Matter of fact, let's take a look and go all the way back to the 3 month and look what you got there. On the 3 month level, which actually going back about 1.5 months, look what you have. You have a low, and a low. You have higher lows. And then since you have this thing I was originally drawing here, you have this closing channel here. Boom, and then boom. Look what you got. You got a lot of pressure building in there. That pressure right there is going to release somehow, some way, and it's probably going to do so like that. And the reason why I think that's the case is because look at the Dow Jones. Look at Scott Minerd, what he's saying. A lot of people are saying the same thing. Fear is still in there. It's still in the market. And in addition to that, we're in summer. People say sell in May and go away. Had you done that, you would have made a massive amount of money because you would have took all the benefits of May, which is a huge, you would have got rid of all the loss in May. You would have experienced none of it. And just having walked back into the market on June 3rd, which was like the first trading day of June, it would have been first, second, or weekends, then third, and then boom, you'd experience a $1,200 rise in the Dow Jones and S&P. We're talking per couple, like what? It's been up like 1%, 2%, like twice, 2 days, 3 days. So you end up in a situation where that would have just been, wow, most people would never do that. But the point is just to say it actually worked this year so perfectly. It was almost unbelievable. It was literally from May 1st to May 31st that it was an effing disaster. And then as soon as you come back in June, it's like the wonder world. You know what I mean? Everything's a utopia. So I'm expecting things to downturn. It's why I keep being a bit pessimistic and why I know for a fact the smart play soon is going to be put options. I don't know which ones are going to be. Look at Apple. Tried to go for it, couldn't break that resistance at 196, and now it's a red day. They're going to have to break it tomorrow, or at least by the end of the week, they're going to have to get above that. Because if they don't, they're going to get pulled right back down below the resistance. The last thing Apple wants to do is fall back down below those right there, where that 187 right to the left of it, that's your 9-day and your 13-day EMA on the 3-month. Let's look at it on the 1 month. Right there, very clear. You do not want those to end up coming up and have that fall through it. Because if that falls through it, it's going to be back below those, the 200s and the 50-day SMA. It just won't survive. It will do exactly what Scott Minerd said. It will pull a junkie stunt, trick everybody, and then you're going to end up in this situation like, let's look at the 6-month. So it will be like that. Okay, forgive me. Let's go to the 1 year. Yeah, it could be end up being a tightening range like this. Let's just imagine you could take this out for a minute. You'd be going like this. This is what it's going to look like. So boom, 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 boom. And then it's just going to get in a tight range where you get this pressure building. And then the scary thing is just usually from that, when a stock looks like this over the 5-year, usually from that, you're going to, matter of fact, look, you can look at this is what it's going to do, exactly what it did here. This is the last time it did that. Look right there. Let's take a snapshot of this. And this is like the mini of that. There you go. It's beautifully done right here. You got the boom, 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 boom. So it's doing it right there. And then look, it couldn't get up. And look where it did. Boom. Went to 90. From 135 to 90. Well, these swings are way bigger because the market's been even wild. So it'd be like that, 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 that. And then it'll be deeper like it is there. It's deeper than the rest of the drop, so it would have to go deeper than 150. So it'd be like 130, 128, 135. That's what you'd be looking at, as wild as that seems. So these are all realistic possibilities. Let's take a look at some of the other ones. Let's take a look at Facebook on the 5-year. It's just been straight up, so it just did a correction. We have nothing to look at there in terms of Nvidia. Nothing. I mean, these all should be correcting. There's no doubt about it. Look, there's nothing in the chart that explains why, except it could be I mean, look at that. If it's not done, if it's just doing its first drop like it did here, look, remember, if you're going to go back to the 1 year, going back to the 1 year brings you here in October. The first drop, then correction was like this. It was like a drop, and then drop, and then a correction. Well, that correction was very short-lived, boom. And so if this ends up doing it, it'd be like this, like that, and then what? To here, to 119. Does that seem possible? Absolutely, 100%. There's no doubt in my mind that's possible. And there's no doubt in my mind that's possible because if the only thing keeping everything alive now is free money from the Fed. If you actually get Trump coming with harder tariffs, China hasn't even said anything. I hate to sound so pessimistic, but China hasn't even said anything about what they're actually going to do in response to what Trump did. Because remember, they said there's going to be retaliatory measures for everything we do, but they haven't selected what it was. Initially, people were afraid. They said, oh, it's probably going to be they're going to punish Apple. Apple got destroyed as a result of that. Then people were like, that's unrealistic. Goldman Sachs people were like, that's unrealistic. Come on, get out of here. What if they did? Imagine the shell shock that would happen to the people investing in Apple if China's like, Apple cannot do business in China. I understand they'd punish so many of their own people, but keep in mind, if Apple's not selling products there, then someone's going to, and that's why it made me a little frustrated about Goldman Sachs saying that. It's like, what do you mean? Think about what you just said. If they're not selling the phones to people, then someone else will, which means that other company is going to be able to hire people to make the phones. They literally just replace Apple's employees and take them and put them in their place. And then everyone will not buy an Apple phone, instead they'll buy this other phone. I mean, this would literally be if like they made iPhones illegal. So keep in mind, that's totally possible to do that. Just like how we make Huawei illegal and you can't do any business with them. They could absolutely do it. Doesn't mean they're going to. No, and I'm not going to be trying to ring alarms that shouldn't be rung. I'm simply saying we don't even know what it is yet. And we're running to the train that's supposedly going to be passing out more free stimulus and money because interest rates will go back lower again. I'm not buying that. I'm not buying that that's a good idea. Say, here, load up some more debt while business gets down, in addition to the fact there's too many people saving. I mean, think about the number of people that are running to the stock market. It's no wonder why they're out there trying to steal our money, meaning the big dogs in the government, because they're like, you're saving all your money. If you're saving it, it can't be spent. If money is not being spent, how can earnings go up? If earnings don't go up, stocks cannot appreciate. There's only one way to force stocks to appreciate, and that's to force money out of savings and into consumers' hands. So they say, I'd rather spend it than lose it in the fucking stock market. So they go out there and spend it. And then by spending it, they actually buy things, consume things, raise earnings, which looks good, and then brings people back to the stock market. It's very wild. It's a long cycle. It takes a very long time to do. It's what happened in the recession, the Great Recession. Everyone said, man, give me my money. I'm not going to sit here and lose my shit. I'm going to buy Xboxes and shoes. I mean, they just started buying, like, it was crazy. People buy more weed. Now weed's going to be legal, but they're just buying shit, drinking more, eating more, spending more time at home because you're not working, consuming more electricity through your AC and all this stuff because you're actually home and doing more stuff. So using more gas now that you're driving around to the beach and other places because you're not at work. And this was seriously what people were doing. And Obama at that time was giving people money. Consider that for a minute. He was giving us all like a check, doubling up the unemployment, giving out stimulus checks of like $1,200 to $1,500 depending on your dependents. And you got to think about that for a minute. All of that just went out and spent. What did that do? It forced money back into the businesses, which allowed them to say, look, we actually have some earnings again because everybody took their money out, collapsed stock prices, stocks got cheap. People started spending the money rather than losing it in the market. Then the government gave people some money. And the government gave banks money. Banks started lending money. That's the way things worked because that's the way they had to work. We're not anywhere near that right now. Our economy is actually very healthy, but I'm simply saying there is such a thing as too many people saving money. And that's the problem with the stock market getting to 40,000. Like people say, get to 40,000. Well, I mean, that's possible for sure. 30,000 is possible for sure. But once it gets there, if you consider what it's actually done, it had to require a lot of saving, unless it's a fugazi, fake, low volume, parabolic rise, which is a disaster and just plagued with bad outcomes whenever that happens. But let's look at if it's a realistic thing, if it's a healthy thing, and everyone's actually is getting in it, and you're seeing earnings go up because, the companies are squeezing as much margin as they can out of everybody. Well, then things are getting expensive, and at the same time, people are trying to save. Well, that means that the only way the earnings are coming at an increasing rate is because prices are being raised. There's not actually more being sold because people don't have actually more money to buy more of it. They only have that little bit of extra to pay a little more for what they do buy. That's a dangerous situation, and that will call for correction. So people back up. Market companies will have to innovate again to find a way to make things cheaper, and you're just going to have that cycle. And this is part of the cycle. The correction that is coming is totally healthy. It's part of the cycle. It has to happen. I agree with Scott Minerd. It's going to be something in the realm of 16-20%, and that's going to be what it is. And I don't know if it's going to be tomorrow or about 9 months from now, but I mean, it's coming. And I think we just all need to remember that. And when you look at the Dow Jones, you see that chart, sometimes you're like, there's no possible way it could be that obvious. And then that's exactly the way it happens because it was so obvious no one thought it was really going to happen. But that's it. We'll end that one there. It's just some people ask me, why am I bearish? Why do I have a bad outlook sometimes and sound like I want the market to go down? I don't. I just don't want to be unrealistic, and I feel like it needs to do that to get it over with. It started it. It got it mostly there. And then this stuff happened, and meaning it was just happening recently with the Facebook and everything collapsing, percentages every like 5, 6, 7%. And then all of a sudden they came out, we're going to lower interest rates. And I understand that's because scrutiny that they were putting on it, that was because a lot of other stuff, regulators and stuff like that. But all of that stuff culminated with the government interfering with a lot more than they should. You know, a lot of bad news about trade wars, tariffs, you know, Mexico now, you know, Brexit and European Union, central bank, and all, you know, everybody now looking at things the way they were looking at them. It started to really culminate, and then they were like, okay, we're going to start potentially drop interest rates. And now we find out that we're looking at September, October. So it is what it is, but that's why I can stay a bit bearish, even when the market's going straight up. I'm like, this doesn't make any sense. Only because I'm realistic and have realistic expectations. But tell me what you think. You may totally disagree with me and think I'm a fool. If so, let your boy know. Show love. I love you guys. Peace.